Welcome back to our valuation series. In our previous capsule, we explored PE ratios, which compare a stock's price to its earnings. Today, we're diving deeper into the gold standard of business valuation, discounted cash flow analysis, or DCF. Think of DCF as the ultimate "what's this really worth" calculation that professional investors swear by. Let's start with a simple question. Would you rather have $100 today or $100 next year? Most people choose today, and they're absolutely right. Money today is worth more than money tomorrow because you could invest that $100 and earn returns. This fundamental concept drives everything in DCF analysis. The DCF method works by answering three core questions about any business. First, how much cash will this company generate in the future? Second, what's that future cash worth in today's dollars? And third, based on those calculations, what should we pay for the stock today? Let's break down each component. Future cash flows are the lifeblood of any business. When we say cash flows, we're not talking about revenue or even profits. We mean actual cash that flows into the company's bank account after paying all expenses, taxes, and necessary investments to keep the business running. It's the money left over that could theoretically be distributed to shareholders. Projecting these cash flows requires analyzing the company's business model, growth prospects, and competitive position. For a mature company like Coca-Cola, cash flows might grow steadily but slowly. For a tech startup, they might explode upward or remain negative for years while the company invests in growth. Now, here's where the discounted part comes in. Remember our $100 question? Future cash flows need to be converted to present value because money later is worth less than money now. We use something called a discount rate, which reflects the risk of the investment and the time value of money. The discount rate is like an interest rate working in reverse. Instead of calculating how much money will grow, we're calculating how much future money shrinks when brought back to today. A safe government bond might use a low discount rate around 3%, while a risky startup might use 15% or higher. Let's walk through a simple example. Imagine a lemonade stand that will generate $1,000 in cash next year, then shut down. If we use a 10% discount rate, that future $1,000 is worth about $909 today. The formula divides next year's cash flow by 1 plus the discount rate. But real companies don't just operate for 1 year. They generate cash flows for decades. This is where DCF gets powerful, but also complex. We project cash flows for many years into the future, discount each year separately, then add them all up. The sum represents the company's intrinsic value. Most DCF models split this into two parts: explicit forecast years and terminal value. The explicit forecast covers maybe 5 to 10 years, where we model cash flows year by year. Beyond that, we estimate a terminal value representing all cash flows from year 11 to infinity. The terminal value usually represents a huge chunk of total company value, often 60 to 80%. This makes DCF analysis both powerful and dangerous. Small changes in long-term assumptions can dramatically swing your valuation. So what makes a company worth more in DCF terms? Three key drivers stand out. First, higher cash flows obviously increase value. Companies that generate more cash, either through higher revenues or better margins, will score higher in DCF analysis. Second, faster growth multiplies value. A company growing cash flows at 15% annually will be worth much more than one growing at 5%, even if they start from the same base. Growth is incredibly valuable in DCF because it compounds over time. Third, lower risk reduces the discount rate, which increases present value. Stable, predictable businesses with strong competitive moats can use lower discount rates than volatile, risky companies. This makes their future cash flows worth more today. Let's consider a practical example. Netflix, in its streaming growth phase, showed how these factors interact. The company was burning cash in the short term, but projecting massive future cash flows from global subscriber growth. Investors using DCF had to balance high growth potential against execution risk and competitive threats. DCF analysis isn't perfect. It's only as good as your assumptions about future performance, growth rates, and risk levels. Small changes in inputs can produce wildly different outputs. This is why Warren Buffett famously said he's never seen a DCF calculation he couldn't make work. Despite these limitations, DCF remains the foundation of professional investing because it forces you to think fundamentally about business value. Unlike PE ratios that compare market prices, DCF asks what the business should actually be worth based on its ability to generate cash. The beauty of understanding DCF isn't that you need to build complex models, it's that you develop intuition for what creates real value. When you hear about a company's growth prospects, competitive advantages, or financial stability, you can connect those factors to cash generation and discount rates. To wrap up, remember DCF's three core components: projecting future cash flows, discounting them to present value using an appropriate rate that reflects risk and time, and summing everything to estimate intrinsic value. This framework helps you think like a business owner rather than just a stock trader. In our next capsule, we'll explore another crucial valuation method, comparable company analysis, where we'll learn how to value companies by comparing them to similar businesses. Until then, start noticing which companies in your portfolio generate strong, predictable cash flows versus those that don't.